Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, India VIX, the volatility index, surged to a 7-month high recently, reflecting the nervousness and anxiety among investors. The markets are jittery, and that could be because of several reasons. It could be because of the FII selling in large amounts, or possibly because of the ongoing elections, low voter turnout, or because of the geopolitical disturbances. Let's try and understand this in today's episode from Dhirendra Kumar. Moreover, let's try and understand what should we as investors should do in such market circumstances. So first up, what is market volatility? Why is the market volatile? And what should investors do?
Market volatility is exactly what the dictionary describes as volatility, something which goes up and goes up and down more often is referred as volatile. Markets are more volatile simply because, money is at stake. When it comes to market, it is used in a very unusual way. People refer to volatility when it actually declines in value. Volatility is something which goes up and down, not necessarily goes down. People are embarrassed about saying that market fell. So they say market was volatile. No, market fell. So differentiate between these two. One is the usage of volatility. Right. Markets are designed to be volatile simply because, we are not trading in fixed income. We are not trading in something which has a defined price. And then now the market is completely integrated with the world. The market has gone up by 63% for mid-cap stocks, gone up by 20% on Sensex, and gone up by 59% on small caps. So if market goes up by this much, so many people will be nervous about it that, okay, market is falling a little bit. They will think that, okay, it will fall so much more because you're sitting on profit. So fear of height, dynamics of the global uncertain world. And, this kind of uncertainty, we might be, thinking that it's become more volatile because of this uncertainty. But markets are, they are facing this uncertainty all the time. Whether it be election, whether it be war, whether it be geopolitical tension, whether it be disruption of the logistics, COVID was a huge disruption. We are venturing into an unknown territory and the integration of the market. So markets are volatile. They were volatile. They will remain volatile. And volatility can only rise, can only grow. But despite this, market goes up over a period of time, over a long period of time. There is an India tailwind. For the first time, we are witnessing pre-election, we have seen a roaring bull run. And there could be disappointment even when there is not a disruption. Like everybody saying 400 par. So 380 will not look very nice. Getting an absolute majority might be disappointing. Besides that, the speculative tactical dynamics of it. On a given day, there is a futures and options settlement going on, and on a given Friday, there is something, and now we have one week derivatives that is coming to the market. Many individual investors are speculating. They get trapped because of some 2% movement here and there, because 2% movement here and there translates into something like 30-40%, somebody getting into money, somebody getting out of money. So people are getting bankrupt with their speculation of this such, even sometimes not very meaningful moves. So markets will be volatile. We are sitting on huge profit. Any SIP investor would realize that he has been such a lucky investor. And tentatively over the next 3-5 years, I don't think there is much to worry about. We have far more uncertain but promising outlook waiting for us. But promising but uncertain in the same breath is what I'm saying. That uncertainty will cause volatility, and it is going to remain like this forever. The market will keep looking for an excuse on a day-to-day basis. Someday it will be excited, someday it will be disappointed. And over the medium term, there is every reason to be optimistic.
Apart from everything else that's happening, it's basically the elections, the ongoing elections, and people, say that elections have had a bearing on market sentiment year after year. So can you shed some light on that?
My understanding is that everything has an impact on the outlook of the market. Interest rates have, weather has, health conditions have. This election, the mood of the market clearly reflects that the market is very confident that this government will come back. This government is coming back with a thumping majority, or with a bigger majority. And it comes with a reasonable majority. Some people will be disappointed. Most people will think objectively that, okay, there is going to be continuity of everything. My sense is that, it matters very little in the long run. The market was up 27% in the run-up to the 2009 elections. And that was very significant. This election is even bigger. The biggest surprise was 2004. The market opened up and market went into a downward spiral because everybody expected that Atal Bihari Vajpayee's government is going to come back. That India Shining campaign was very interest arousing. It was actually rekindling all kind of expectations and hopes, and that government could make. And then we had a UPA government. There was no form, the UPA was,
coalition.
It was a coalition, and that turned out to be a dramatic thing. Market went into a downward spiral, and it went so dramatically that the whole market, most fund managers were caught unaware. Everybody was fully invested. And then that was the only occasion where I saw that most fund managers, they pulled out from equity and created a cash position, anticipating that this is the beginning of a decline, or this is the beginning of a lingering decline. And it did not happen. In 10 days' time, the market recovered, and that was one of the biggest negative surprise. So right now we are in the middle of a very extreme optimism, and if there is any disruption to the premise that is actually fueling it, we can be in for a surprise. And 2004 is a grim reminder that markets can go into a downward spiral of a dramatic kind. If such a thing happens now, we could be in for far worse than then.
So there's huge optimism in the market. Why is the market still jittery? What is the reason for that then?
Market is not jittery. If you are sitting on 60% gains, you would like to cash out a little bit. Then foreign investors have a very significant role to play. And what you are referring to as jittery is basically 1 or 2% decline after market has run up by 60% for a day or two. And market is still at an all-time high. It has never slipped from the all-time high by 10%. It has never gone into a steady decline state for a month or two. It has happened for a day or two and once in a while, and there are all kind of technical, tactical dynamics of the market. FIIs pull out, that coupled with some settlement in the market on the derivatives or things like that. I don't think there is we can say that market has gone into a downward spiral or a secular decline, and this is very much part of that is by very much the design of the market. It is volatile, it has been volatile, and markets, when they go up dramatically, they become more volatile.
All right, so what should investors do?
Which I keep repeating, and I will repeat it at the cost of sounding like a stuck record, that keep calm and carry on if you are onto a plan. Basically, every investor will fall into one of the three brackets. Either you are a normal investor, earning, saving, and investing every month. That is one. So you should carry on with this plan. Nothing to do, because even if the market goes down or goes up, you can't do much about it. If you are still investing for next 10 years, if for your retirement, for yourself, it won't even matter. Second is that, you are waiting with some money that, okay, market will correct it because it has gone up and you have been waiting for that opportunity. You will keep waiting. You will not get an opportunity. Last 2-3 years, people have been waiting and they should give up on that. What you should do is, investing at the peak, you always run the risk of catching a market high, and the market correction will actually scare you. Spread it over 5-6 months, spread it over next 1 year, spread it over next 2 years, depending on the scale of money. But invest. Don't wait on the sidelines because you will keep waiting forever. And the third kind of investor is, you have worked hard all your life, you have saved all your life, and you have been investing all your life, and now you are sitting on a huge accumulation. Those people should do something which is not pull out of the market. But if you are getting closer to spending it, closer to consuming it, if you are nearing retirement or nearing a plan that you have to spend that money or a part of that money, then bring some fixed income allocation to it. Because most investors have been in a very binary state. You start with an equity fund, keep sitting on it. But over a period of time, if you have something meaningful, when you have something to lose, then have your asset allocation. Maybe 10% allocation, 25% allocation, but have that. So that you can benefit from this volatility. So this is a simple plan to follow.
All right, so great news. Nothing for you to do. Just that you can rebalance a bit if you're nearing your goal. Now, there's a viewer's question. Prem asks, Indian markets are at an all-time high. Globally, the scenario is opposite of India. What is the investment strategy you are recommending for the near and long term?
Same strategy, what I was saying, that near term, long term is entirely guided by your state. And which is the basic principle that invest for the long run. Diversify, choose a good fund. If you can't choose build your portfolio. If you are investing in stock, buy 15, 20, 25 stocks so that you're not exposed to any dramatic things happening. You can't know about a company beyond a point. Nobody knows. Once you have these basic things in place, long-term money getting invested in equity and is diversified, then you have to see that what is a special thing that you can do. Can you be tactical with your asset allocation? Should you be 100% into equity? Should you be 80% into equity? And if that is the case, but one thing I would suggest that anybody trying to be tactical with equity, assuming that you are very optimistic, don't do this, that you will borrow against your investment and invest more. Never borrow to invest more. Unless there is some emergency and you don't want to disrupt your long-term plan and you have a short-term need, there is absolutely no need. So don't over leverage yourself. And for the near term, it should entirely be guided by your needs. If you are likely to need the money in any time period, which is 3 months to next 1.5 years, start creating, your fixed income fund, fixed income allocation, and be invested there, so that it is none of your real life plans or financial plans should be dependent on the state of the market.
All right. Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.